Yesterday, I did a video based on how the banks showed such outstanding profits in the third quarter of 2020 when they were receiving no mortgage payments, they were receiving no few credit card payments, that they had no cash flow. But yet, they showed extraordinary profits, both Goldman Sachs and Morgan Stanley and many of the others. And other banks showed terrible. And the difference was the money that the federal government had channeled their way through the Paycheck Protection Plan and how they used it to trade in the markets. And again, this is speculation on my part. I know no other way that they could have shown a profit. Now, this weekend, I am informed from one of the tribe members, Ran Gavriely, who lives in Croatia, and he has been on our channel before, if you remember. And he's been following the switch that is going to occur relative to the LIBOR rate. The LIBOR rate is the overnight rate that banks charge each other to balance their books. In essence, what it is they are told that they have to have so much cash on their books every morning when they open for business. And if they don't have that, they borrow it from other banks who have more than what they need. And that's the overnight LIBOR rate. And it has become something of a joke, if you will. It's not based on fact. It's based on what the 14 largest banks in the world say the rate should be or would be. And it's really not an overnight rate. It is a average of up to a year's worth of rates. So it doesn't have any substance, and it's not secured. So there has been a movement because particularly back in the financial crisis, banks weren't loaning to each other because they didn't know how solvent they were. So in roughly between 12 and 14, the decision was we need to change how this is done, and it will be implemented in 2021. Now, we've learned through a Bloomberg report this last week that they're going to implement this on roughly $80 trillion worth of debt, mostly in credit default swaps. And that represents a small percentage of the overall debt that it could affect, which would be somewhere in the neighborhood of $600 trillion. This is going to be $80 trillion. So the concern then becomes, how is this going to affect the overall markets? Is this going to affect the liquidity of the overall markets? And as it becomes general knowledge on Monday morning, this morning, how is it going to affect the markets? And how is it going to affect it with everything else that is in flux right now? Everything from an increase in virus cases, an election that's coming up, how maybe the banks didn't have the flow of money that we thought they did, that in fact it came from the federal government, the fact that our debt continues to increase, the fact that just this month, $3 trillion in operating deficit, where we surpassed our gross domestic product. So there's a lot at flux right now. What if we have an election and we change administrations and Powell and Mnuchin get booted out? How does this affect the banking system? Does inflation allow interest rates to go up? And if they do, how does that affect this LIBOR rate? How does that affect this $80 trillion worth of debt, which benchmark is changing effective tomorrow morning or this morning? A lot up in the air. So with that in mind, and having just learned of this, I wanted to talk to Ran Gavriely more in detail because he's been following it for about a year. So here's my conversation with Ran. This is Ran from Croatia, and you might remember that he's a member of the tribe, and he did a video for us about a month ago, and so he's got a video channel. But Saturday morning, he alerted me to something that is happening relative to LIBOR. So I'm going to turn it over to Ran and let him give us his interpretation, and then we'll talk about it a bit. So, Ren, tell me what your interpretation of all this is.
Okay, so first of all, we need to understand just what is the LIBOR. And the LIBOR is the London Interbank rate, which basically this is the base interest rate that almost every loan that is made in the world, this is the base rate that they are starting the loan from. So you can have a LIBOR plus 2% or LIBOR minus 1. And this is affecting consumer loans, but also commercial loans, corporate debt, bond issuance, mortgages, car loans, credit card, everything. And this LIBOR rate was used since the 80s. And in the great financial crisis in 2008, they discovered that it's very problematic. And there is some problems with it because it can be manipulated. Mm-hmm. It's not so much based on the real rates that banks are lending on, because it's supposed to represent the rate which banks are lending between themselves. Overnight. But actually, it's not really what?
Overnight.
Sorry? The LIBOR is not only overnight rate, it can also be a weekly rate or a monthly rate or a yearly rate. It has up to 1 year.
Okay.
And it's an unsecured loan, so there is no collateral behind the loan. And that is important because we will see soon that we are moving to a different standard that is secured, but also the new standard is only overnight. So this is a big change from what we have now. It's like apples and oranges. It's not the same. And this can cause a big problem. Now, the problem is that the banks were manipulating this rate by quoting much lower rates than they were actually borrowing. And especially it was apparent in the financial crisis. The banks didn't trust each other. They didn't know who is solvent, who is not. So actually, they were not lending at all. There was zero lending. So right. Theoretically, the interest rate was infinite. But they were quoting that they are lending to each other in 1 or 2% because they didn't want to look like they are in a crisis. For many reasons. They didn't want regulators to come on them. They didn't want other banks not to lend them because they look weak, and so on and so forth. So obviously this LIBOR had to be changed into a better rate, a better interest rate system. Benchmark.
Yeah.
Yes. So, but even that the regulators want to change into a better system, it doesn't mean that the transition will be easy and smooth, because there is hundreds of trillions of debt that is already working on the LIBOR benchmark. So just in the US, the lowest estimates are talking about $200 trillion, and the higher estimates are talking about $400 trillion. Wow. And then Europe and Asia, you are talking about another between 400 to 800 trillion in Europe plus Asia. So this is a big deal. And by the end of 2021, LIBOR is supposed to be completely deprecated, let's say it like that. So there will not be any more quote of a LIBOR after 2021. So this is the first time that they are starting to change in the United States some of the debt into the new benchmark. And it happened over this weekend. And we are talking about 80 trillion, so it's a small percentage of the entire debt that is on LIBOR, but it's still a huge amount. 80 trillion is a number that is really hard to comprehend.
So why did they pick this weekend, and why did they segregate it down to 80 trillion?
Well, that's a good question. For what I understood, this 80 trillion is mostly, it's not mortgages, so people that have mortgage, they will not suddenly see a different rate that they are paying monthly if it's an adjustable rate. If it's a fixed rate, then you're okay. But this is mostly derivatives, credit default swaps.
Okay.
And I will explain credit default swap very shortly. It means if you have two entities, and let's say I have a fixed rate loan and another entity have adjustable rate, and that we want to change. I want to have an adjustable rate and they want to have a fixed rate. So we change it, but there is regulation that says that there has to be a middleman. So the middleman is a big bank, like let's say JP Morgan, and then the bank is taking all of the risk. So if I'm defaulting, the bank is going to pay the interest plus the principal to the other entity. So the banks are taking huge risk, and they get for that a small fee.
Okay.
And this is basically what is changing over this weekend. The benchmark on this kind of loans, credit default swaps. And what can happen because of that is that the value of those credit default swaps can go up or down. So you can suddenly see that a certain bank can have much less assets or much more assets. It can go both ways.
So it's the banks then that are at risk.
Yeah, and also some corporation. If you have adjustable rate loan for your corporation, suddenly it can go up. If it goes down, it's fine, it's good. If it goes up, maybe you cannot pay anymore, and then the banks are on the hook for you defaulting. That's the problem.
Okay, so what is your best guess as to what the effect of this will be Monday morning and then beyond that?
I expect a lot of volatility. I don't know if we are going to see some crash, but obviously it's a possibility. The worst case scenario is this leading to some kind of a banking crisis. I don't think there is a high chance for that, but it exists. So everyone needs to be aware of that.
My interpretation, Ran, is it's another element of fear. We have the fear of the corona crisis. We here in the United States have the fear of the change in a administration and what that could result in. We have a lot of uncertainty around the market right now. I just did a video today explaining how the banks were basically bailed out through the Paycheck Protection Program, that $600 billion was thrown into the system that they then were able to use to prop up their earnings. And now we have the fear that the real estate market is going to crash as a result of all the foreclosures that are coming and all the loan failures on small business that can't be paid. So that's putting a lot of pressure on the banks. And now you're adding this uncertainty to it. And I think the other element of it, it's not clearly understood. It's like you and I were talking about, we're the only two people talking about this.
Yes, it's barely mentioned anywhere. Just some Bloomberg was keeping on track of it every few months, but just that.
It's I'm like you. It's kind of, I don't know what your source of financial news other than the internet is, but we have multiple TV shows that every morning talk about the markets, and there's never been a mention of this whatsoever. That my understanding from what I've read that you've cued me to, it was anticipated that this would kick in 2021 unless, and as I understand it, it was that the 12 largest banks in the world reported this, and once it fell below 4, this would trigger by itself. And I'm just wondering, and I'd like your input on it, do you think that a number of the world's banks said, this is a sham, we know it's not based on fact, it's based on, what did you call it, a lie, and less than four of them said are willing to put out the information anymore. Could that be what's triggering this?
I think it's the regulators that are came on the banks, and they are forcing them to change from this LIBOR. But I have first heard about it about 1 year ago.
Okay.
But I believe this is something that was going on since '08, and I think it started to kick in into. They started to think just we need to change this, and then in 2012 or 13 they really started to think, okay, we need new benchmark.
That's
So
what
the
I read.
new benchmark that we are changing into is from the Federal Reserve. They offered it.
So the Federal Reserve is forcing this issue? Is that what you're saying?
For what I understand, the Federal Reserve and also the Central Bank of England.
Okay.
So they also have a different benchmark that they are trying to push. It's called Sonia or something like that. But for what I understand, everyone will start moving to the Federal Reserve benchmark.
Okay. And this
This SOFR.
SOFR. And this is the Treasury rate on, do we know, is it the 10-year, the 30-year? What do we know what rate it is?
Well, SOFR.
Yeah, but I mean, SOFR is based on what exactly?
It's an overnight secured rate. So that means that's the rate on which, let's say, if there is two banks and one bank want to lend from another bank. So what would be the interest rate if, again, let's put it like that. There is Bank A and Bank B.
Right.
Bank B want to lend from Bank A. So Bank B will give Bank A, let's say, some treasuries. So it's secured. There is something behind it. Okay. And then Bank A will lend to Bank B. Obviously, this is a much lower rate than LIBOR, which is unsecured. So now you need to move all of these loans that are based on an unsecured rate, which can also be a weekly rate or a 3-month rate or a 6-month rate, right, and so on, to a rate that is only calculated every night. So every night it's different, and it's a secured rate. Imagine that in the US you are using pounds for weight, and you are using miles for kilometers. Imagine you are now in one day, there are all the signs on the road, they change to kilometer an hour, and you are starting to measure things by kilograms. I mean, how much confusion is that causing? And this is only in this is a in loans, and now they need to convert all the loans to this new benchmark.
So it's going to be it could be a good thing, it could be a bad thing, but either way, it's confusing.
Yes, it could be a good thing. It's not necessarily a bad thing. So let's be positive about it. But it's we're talking about such a big number of debt. So even if they are just mistaking on a super small percentage, a 1% mistake from 80 trillion is 800 billion. Yeah. So that's the risk that is involved. And it's already said by the clearing houses, which is basically where the big banks are settling derivative contracts and trades, that they are going to they expect some banks to benefit from this and some banks to lose from this. So the clearing houses already said they are going to take from the banks that benefit and give it to the banks that lose. So they already expect massive losses. And JP Morgan told to his clients that he's not taking responsibility for losses that they will have in derivative contract. That means if you're involved in shorting stocks and suddenly the value is going down, they're not taking responsibility for whatever is happening. Okay. So if you have puts or calls on stocks, also it can be affected. This is derivatives that can be affected by this change.
So tomorrow morning could be very interesting. And as they interpret it,
also for people that have margin, it's very dangerous because when you have margin, you borrowed money. This is going to change. If you have margin, I see it as a risk, very high. It's uncertainty, so it's risk basically.
Okay.
The way that
my interpretation then is, it's an event. It will sort itself out, but when events occur and there is confusion and fear, people react, and it could affect the liquidity in the market, and it could have an adverse effect. So,
That's a very good way to put it. Yes,
yeah,
I
and
agree.
I think the how I'm going to react is if I see a reaction and a drop in the market, and I see Amazon's price go down, or Facebook's price go down, or Google's price go down, I'm a buyer because it's going to settle out. And these are companies that have good, strong balance sheets. They don't have bad debt on their books, and so they'll come out on the other side quite well. That's my interpretation and how I'll react to it. So,
So I took a similar course, and I already heard about it before the market closed on Friday. So I could have gotten out, but I have a long-term plays, and I just stayed. I expect there is possibility of a very high volatility. Maybe I will be down 20%, but I trust in the investment that I make, and if things go down, I have some cash on the side, and I'm gonna increase my holdings. And
there you go. Well, Ren,
yes.
I want to again thank you, and I just want to emphasize that this is truly the value of what we're trying to build in Best of Us Investors and the Tribe. That we share information and it gives us a leg up. At least we're going into Monday morning in anticipation that something will happen. We don't know what it is, but we're not going to be surprised if something does happen. And that gives us a leg up.
Exactly.
Okay.
I totally agree.
All right. Okay. I hope that gives you a better handle on what's going on. I want to reflect back on something else that has happened. Back in February, I did a video in which I showed a interview. I believe or I know it was with Warren Buffett and Charlie and Munger, and how they were disturbed about the current markets and how they had moved something in the neighborhood of 128 billion in cash. And in that interview, if you'll watch the video, you'll see that Warren makes the statement of something like the system is broken, and when the system is broken, it's going to correct itself, and I'm just not comfortable with it, and I know it's going to correct itself. And this was an interview that he gave prior to the pandemic. Now, he didn't predict the pandemic, but the pandemic caused some issues. Subsequent to that, in August, Warren, through Berkshire Hathaway, put $563 million into Barrick Gold, a gold miner. And what that cues to me is that Warren and Berkshire Hathaway are not comfortable with our current dollar situation, which comes back to they're not comfortable with our banking situation. We add all this together, and I think Warren and Charlie's worst fears but beliefs are about to come to fruition. I think we're going to see, if not today, Monday, we're going to see some volatility. We're going to see some people who are scared to death about what's going to happen in the future to their credit default swaps. People who have and this 80 trillion that is coming into play doesn't include you if you have an adjustable rate mortgage or an adjustable rate business loan. That will transition in the future into this new, rather than LIBOR, SOFR, SOFR, a secured loan, a truer representation of what money costs on a daily basis. This is going to create volatility, and that volatility is going to be stimulated through fear and uncertainty. And there's already a lot of fear and uncertainty in play. Are we going to get another stimulus package? If we are, how is that going to affect inflation? If we have inflation and that SOFR, S-O-F-R, rate goes up, and your loan is now based on SOFR plus 3%, and LIBOR, which it used to be, was somewhere around 1 or 2%, and SOFR now, through inflation, goes to 4%, and your debt service now doubles or triples. What happens? That's the fear. Bloomberg's, who is the only one that I can find that has done any reporting on this, calls this the Big Bang. The Big Bang, going back into the TV show, was where two planets came together and crashed and exploded. That's an interesting picture when you put that kind of label on the stock market and the banking situation. The other comparison I have heard is relative to Y2K. For those of you who don't know what Y2K stands for, Y stands for year, 2 stands for the 2 of 2000, and K stands for the 1000. Back in started in 1998, there was a fear that of all the computer programs and all the computer software that was based on the year structure 1992, 3, 4, and then it gets to 1999. What happens when it switches to 2000? I was a financial advisor at the time. I had people who went totally to cash. I had one couple who sold their house, bought a house out in the wilderness of Alabama, stocked up with food, all kinds of water, supplies, ammunitioned themselves because they thought the world was going to come to an end as a result of Y2K. That's the label that Bloomberg has put on the Big Bang. So you need to be aware of it. You need to react to it. I can't tell you how to react to it. I can't tell you if it's going to have any effect whatsoever, but I'm aware of it. And so I won't be surprised if something happens. That's the whole premise of Best of Us Investors. We're a tribe. We're going to help each other as Ran has helped me, and I'm sharing it with you, 55,000 of you, so you can make an informed decision based on what happens tomorrow. I am not going to share with you on here what I'm going to do. What I will do, and what I have done, is I share that information on our Discord. Our Discord, I call our village, is part of Best of Us Investors. You go to bestofusinvestors.com and you sign up and give us your name and your email address. And the very next morning, I will send you a letter, an email, and in there you will find a link to the Discord. Once you enter the Discord, go to Carrie's Insights. In Carrie's Insights, I will tell you exactly what I'm going to do as a result of whatever happens today. What I'm going to buy, when I'm going to buy it, how much of it I'm going to buy. That's where I'll share that information. And that's where I'll share that information from this time forward. If you want to know everything that I know and how I'm going to react to it and how other members of the tribe are going to react to it and get the benefit of multiple minds so you can make a good decision, go to Best of Us Investors and become a part of our tribe, and we'll share it with you. I'd also encourage you or ask you to like this video and to subscribe to this channel so that we can build this tribe. My goal is to get it, first of all, to 100,000, then 500,000, and then to 1 million. And then we'll make a decision of how big we want our tribe to be. And it may be we'll stop it at 500,000. I don't know. That will be your decision. And then at that point, it may become by invitation only. But our goal is to become better investors, then understand the tax system that we work under so that we get to keep more of what we make. And then our ultimate goal is to build family wealth, to change the lives of those who follow us, to change the lives of our grandchildren, our great-grandchildren, our great-great-grandchildren, and basically make a difference while we're here. So that's Best of Us Investors. We're going to open up Best of Us Investors University, and that is going to be directed at giving you more in-depth knowledge, giving you, if maybe you want to build a YouTube channel, maybe you want to learn how to trade home or flip homes. Maybe you want to build a portfolio of rental real estate. We're going to go into depth in there. I'm going to have an interview with a mortgage broker. Why would you use a mortgage broker rather than your bank? These are all questions you need good answers to, but we're not going to cover that on the YouTube channel. The YouTube channel is going to be more of current information about stocks, about real estate, about bonds, and what's happening today. The in-depth learning will take place at the Discord of bestofusinvestors.com. Join us and grow with us. Thank you.